One of the easiest to spot and certainly most common chart patterns that you will run across in the Forex markets is the rectangle. The rectangle is simply a consolidative move. Normally the market's taking a pause after a trend, be it up or down, and you will have the participants trading back and forth as to who's taking control, the buyers and the sellers. The rectangle is formed by simple two areas that come into play. In this area here, you can see that the buyers had an interest in elevating the price of the currency pair, and in this area here, the sellers came in and felt that the price had gotten too high. There are several different ways to trade a rectangle, and the two most common are to use it to range trade, and in this particular case there would have been about 200 to 250 pips that could have been aimed for every time that you reach the top or the bottom. Of course, the rectangle eventually gets broken out of, and because of that, it's very difficult to range trade forever, and obviously eventually you will be wrong. For example, had you shorted here, eventually it would have come back against you. But having said that, you would have had several successful trades before that happened. The more common way to trade a rectangle is to wait for the breakout. And as you can see, it eventually does break out. And using the same principles of support and resistance, quite often it will come back and retest the level from which it broke out from. The beauty of the rectangle is that it comes in with a built-in measuring mechanism as well. By measuring the height of the rectangle, you now can get a projected target, be it a breakdown or in this case a break up of the rectangle. So for example, in this particular rectangle, as I mentioned before, we were looking at roughly 250, maybe 300 pips, and from the point of the breakout or the retest, same level, you go up 300 pips or so, and you can see that's about where you ran into trouble. So having said all of that, rectangles are very powerful chart patterns because everybody sees them. That is the beauty of the rectangle. A lot of traders who are not patient, though, get frustrated by them because, as you can see in this particular setup, in the Canadian dollar, back in late 2007 to 2008, this rectangle actually took about 8 months to break higher. Now obviously they do happen on shorter time frames, they don't always run this long, etc., etc. But having said all of that, these larger time frame rectangles of course are very potent signals and normally show the beginning of a trend change, and in fact or a trend continuation depending on which way they break. And in fact this particular one was a trend change. As it broke up here, eventually dollar CAD went all the way to 130, which of course was predicated by a decision that was being made by the markets here. It's one way you can think of rectangles, as a decision waiting to be made. In this particular case, you had the decision of, do we continue lower, or has the Canadian dollar appreciated a little too quickly against the US dollar? The latter of the two was chosen in this particular case, but quite frankly, more often than not, you will see rectangles continue. The most common place for them to be a trend change is after a trend line break as well. A lot of times trend line breaks will be followed by an area of consolidation, which in and of itself eventually forms the rectangle. And then the break up or down, depending on which direction you're aiming for, gives you the signal to go ahead and go with the trend change.